Welcome to ECO202 Study Session 7. Price Level, Money and Banking System. Introduction. In this study session, we shall explore the history and the role of money in the economy. Money performs useful functions in the economy, which makes it indispensable for the functioning of the economy. Just as it has its advantages, money are also brought about the problems of inflation into the modern society. Inflation is seen by many people today as the number one public enemy. We will also examine a related system to money, banks. While money is the medium through which economic exchanges take place, banks serve as a useful medium through which those who need money are brought into contact with those who have money, which they do not presently need. In this session, we will examine various categories of banking system, such as commercial banks, specialized banking institutions, and the third main element, which is central banks. When you have studied this session, you should be able to explain the following terms in bold: money and price level. Number 2, highlight the roles of money in the economy. Number 3, explain the demand for money. Number 4, analyze the relationship between demand for money and the demand for bonds. 5, present how inflation can be controlled. 6, explain how banks create money. 7, state the functions of the banking system. And 8, discuss how the central bank controls the money supply in an economy. Functions of money. These functions include the following. Number 1, medium of exchange. This is the most important function performed by money. Money allows the complexity of, number 1, medium of exchange. This is the most important function performed by money. Money allows the complexity of modern economy based on specialization to be possible. This removes barter, which is the system of exchanging goods for goods directly. This is a cumbersome system in which every transaction requires a double coincidence of work. Number 2, unit of account. Money provides a common denominator by which other commodities are expressed. Therefore, this makes it very easy to record economic transactions involving different commodities. As a result of being a unit of account, money allows for the formation of prices, which can then be used for recording transaction entry in books of account. A store of value. Possession of money confers purchasing power on the holder, who can then decide either to spend it now or save for future transactions. More importantly, money as a store of value introduces flexibility into the money economy. It is now possible to sell goods today, store the money until one needs it later on. However, for money to be able to function effectively as a store of value, then it must have a stable value. Rapid fluctuation in the general price level reduces the usefulness of money as a store of value. Number 4, standard of deferred payment. Money also allows for the practice of credit system in an economy. In other words, it is possible to buy now and pay later, or alternatively speaking, to sell now and collect money later on. However, this is impossible in a barter economy. This decoupling of purchase, sales and payments provide much of the development which characterizes our economy. It is the fact that many companies borrow from banks to make use of credit facilities to be able to function effectively. Demand for money. Money could either be held as liquid cash or be used to purchase income earning assets, which would generate some rate of return. The holding of money, therefore, has an opportunity cost, which is the rate of interest that could have been earned if the money were used to purchase income-earning assets such as treasury bills. The total amount of money balances that everyone wishes to hold for all purposes is called the demand for money. Determinants of the demand for money. There are generally three purposes of holding money. These are transactionary motive, precautionary motive, and speculative motive. The three motives are discussed fully below. Transactive demand for money. This is the total amount of money that people want to hold in order to carry out their day-to-day activities, such as settling their bills. The transactive demand for money arises because of the time difference between the receipt and expenditure of households and firms. For instance, while workers are paid wages and salaries at the end of the month, they often need money to meet some financial commitment between one period of salary payment and the other. Money held for this purpose depends on two factors. Number one, the size of national income measured at current prices, and two, the time span between one payment period and the other. Precautionary demand for money. This refers to money held for the purposes of meeting unexpected contingencies. Life is full of uncertainty. Unexpected business opportunities may arise for which a firm may need money to take advantage. If the firm has not made adequate provision for such an occurrence, then it may not be able to benefit from such unexpected opportunities. The demand for money for this purpose, however, depends on the rate of interest. The higher the rate of interest, the higher the opportunity cost of holding money, and invariably the less the amount of money held for precautionary motive. However, the total amount of money held for this purpose varies directly with the size of the national income. Speculative demand for money. This is the money set aside for the purposes of speculative trading. For instance, if one thinks prices are now very low and may rise in the future, the tendency is to buy now and to postpone selling until prices rise, and vice versa. Hence, when prices are low, people will rush to purchase, and this will therefore reduce money held for speculation. On the other hand, in a situation when prices have come down, large quantities of money may be held in anticipation of a more favorable change in price before they make their purchases in the future. The speculative demand for money also varies inversely with the rate of interest. It is very important to note the differences between the transactive precautions and the speculative demand for money. Whereas the transactive and precautionary motive emphasize the role of money as a medium of exchange, the speculative motive emphasizes its role as a store of value. Let's formalize our discussion of the demand for money as follows. Let N wealth represent the financial wealth of households in Naira, thus the Naira sign. At a point in time, financial wealth is given. Household must choose how much to hold in money and how much to hold in bonds. Let their demand for money be denoted by MD and their demand for bonds by BD. The superscript stands for demand. Whatever they choose, their decisions must be such that money and bonds holding add up to their wealth. MD plus BD equals wealth. We just saw that an individual's money demand depends primarily on two variables, its level of transaction and the interest rate. This suggests that money demand for the economy as a whole depends on the overall level of transactions in the economy and on the interest rate. The overall level of transaction is hard to measure, but it is reasonable to assume that it is roughly proportional to nominal income, equivalently nominal output. If nominal income increases by say 10%, it is reasonable to think that the amount of transaction in the economy will also increase by roughly 10%. Thus we write money demand equals to NYL. This equation reads as money demand is equal to nominal income times a function of the rate of interest. This equation summarizes what we have said so far. First, the demand for money increases in proportion to nominal income. If income doubles, increasing from NY to N2Y, then the demand for money increases from NYL1 to NYL2. Thus, it often doubles. Number two, the demand for money demands negatively on the interest rate. This relation is captured by the function L1 and the negative sign under the interest rate, which indicates a negative relationship. This demand for money decreases when the interest rate increases. The relationship between demand for money and the interest rate implied by the equation above is represented in figure 7.1. The interest rate is measured on the vertical axis. Money M is measured on the horizontal axis. MD curve represents the demand for money for a given level of nominal income. It is downward sloping because a lower interest rate leads to a higher demand for money. The money demand curve gives rate, say I, an increase in nominal income from N1 to N2 increases the demand for money from say M2. Put another way, the demand for money shifts to the right from MD1 to MD2. At any interest rate, the demand for money is larger than before the increase in nominal income. Demand for bonds. Remember that demand for money and the demand for bonds are not independent decisions, but that the two have to add up to financial wealth. We can thus look at the demand for bonds implied by the demand for money. From equations 7.1 and 7.2, the demand for bond is given by BD equals wealth minus money demand, which is equal to wealth minus NYL. An increase in wealth leads to a 1-for-1 increase in the demand for bonds. This conclusion comes from our assumption that the demand for money depends on income and the interest rate, not on wealth. Thus, an increase in wealth goes into higher bond holding rather than into higher money holding. An increase in income leads to an increase in the demand for money and thus to a decrease in the demand for bonds. And an increase in the interest rate, which makes the bond more attractive, leads to an increase in the demand for bonds. Price level. Right from the time of the classical economists, economy has been divided into two parts, the real part and the monetary part. Allocation of goods and services take place in the real sector. Only relative prices matter in this part of the economy. On the other hand, money prices or the price level is determined in the monetary sector of the economy. Here, price level is determined by the quantity of money supply in the economy. The classical economists have considered these two parts of the economy as independent of each other. Money has no impact on the real sector of the economy and thus has been considered as a veil behind which actual production takes place. This doctrine is referred to as the neutrality of money. Inflation. Inflation is a period of persistent increase in the general price level. Deflation represents the opposite. All economists agree that rapid inflation or deflation is harmful to an economy, and often many people get hurt as a result. Economists also agree that inflation is a monetary affair. In other words, inflation arises because there is an increase in demand of real goods, thereby leading to increase in prices. The effect of inflation on the economy depends on whether it is anticipated or not. When inflation is anticipated, the necessary cushions are already built into the contract agreement so that people are protected. Another example is the case of indexed wages. Effects of inflation. Inflation influences the allocation of resources in the economy by changing the structure of relative prices, often in an absurd way. Since prices are not rising in the same proportion, commodities which are enjoying high relative prices will witness inflow of production resources which might not necessarily be to the benefit of the society. Inflation also redistributes wealth from lenders to borrowers. Lenders suffer a lot on the real value of their money if they are paid back during the period of inflation. For instance, Mr. X lends Mr. Y 100,000 naira at 5% interest rate for 1 year. If the price level rises by 10% over the year, Mr. X has actually earned a negative rate on the actual amount loan in terms of purchasing power than the 100,000 he lent to him at the beginning. Another major effect is on the fixed income of the people. This is because the purchasing power of their income falls during the period of inflation. However, inflation is not entirely a loss. Some people actually gain out of it. Inflation might also lead to increase in total production, considering the fact that producers gain from inflation and may therefore be encouraged to increase their production activities. Causes of inflation. As we noted earlier in this study session, inflation cannot be permanently sustained without an increase in money supply. Thus, all the permanent causes of inflation are money related. The first cause of inflation is an appreciable increase in the quantity of money supply. When the government prints more money in order to finance a deficit budget or to prosecute the war, this will have the effect of increasing aggregate money supply and therefore the general price level. Another cause of inflation is often excessive demand over supply. That is, increase in demand without a corresponding increase in supply. The increase in aggregate demand might be caused by increase in wages of workers, as we had in Nigeria during the Uidlc award. The consequent increase in cash balance with the workers will cause a rightward shift in aggregate demand, and with a fixed supply curve, the price level will increase. Thirdly, a third cause of inflation is cost push inflation. This is a result of increase in production costs to producers, who then review upward the prices of their product in order to still make profit. A common example of this is the increase in the exchange rate of naira to dollars. Many firms in Nigeria depend on imported inputs to produce, and when the exchange rate increases from about 1 naira to $1 to 7 naira to $1, there will be a corresponding sevenfold increase in their production cost. Thus, they were forced to increase the prices of their output because of the change in the exchange rate. Control of inflation. The control of inflation is always hinged on the cost of the inflation. For instance, for a money-induced inflation, efforts should be made to reduce aggregate money supply. The Central Bank of Nigeria has, for some time now, been trying to reduce the supply of money in the economy through credit squeeze on the commercial banks. Fiscal policy could also be used to control inflation. The government could reduce its budget deficit or rather promote budgetary surplus. Then, through a combination of fiscal and monetary policies, it was thought that the government could reduce the rate of inflation for some level of unemployment. Also relevant here is the famous Phillips curve. This curve was developed in 1958 by Professor A.W. Phillips. This curve suggests that it is possible to trade off more inflation for less unemployment or vice versa. Banking system. Creation of deposit money. This is under the province of the commercial banks. They are able to do this because bank deposits need to be only fractionally backed up by notes and coins. We can illustrate how this process occurs by taking two hypothetical cases. One, when there is only one commercial bank, and two, introduce complications caused by the existence of many independent banks. A single monopoly bank. Assuming there is only one bank in an economy with many branches, and assume that a deposit of 100,000 naira is made by Mr. A in cash, the following transaction will be recorded on the books of the bank as follows. Deposit 100,000, that's under liability, and asset, that's cash, 100,000. With this deposit, it is possible for the bank to create multiple deposits. Let us say that a deposit needs to be backed by a 10% cash reserve. It is then possible for the monopoly bank to create further deposit of 90,000 naira. Assume by way of example that the bank loans 50,000 to a customer and buys 40,000 naira worth of bonds in the open market. This transaction will appear in the bank's books once the borrower has written checks on the loanable amount. Thus, 90% will now constitute additional money to the economy. Thus, a few strokes of pen, the bank has created a further 90,000 naira deposit in deposit money with the original 100,000 naira cash deposit. Many banks. This analysis depends on a number of assumptions. Number one, there are many banks in the system. Number two, the legal reserve ratio is 10%. This is the amount of cash reserve that is assumed to be held against deposit liabilities. Number three, all banks in the system have made loans up to the limit set by the reserve requirement before the receipt of additional cash. Number four, all funds, loans and checks drawn on one bank are deposited in the same on another bank. Number six, there is no cash drain in the system. The process may be described as follows. The first bank, on receiving the 100,000 naira, places 10,000 naira in the reserve and proceeds to lend the remaining 90,000. This is lent to a customer who later writes a check to a creditor for 90,000 naira. The receiver of the check then deposits it in his bank. The receiving bank proceeds to keep 9,000 naira and lend out 81,000 naira. The money comes into the possession of another when it is spent by the borrower and the check deposited in a bank. The receiving bank keeps 10% in the reserve and the rest is lent out. When the original cash receipt of 100,000 naira has diffused itself throughout the system, deposit will amount to 1 million naira and loans up to 900,000 naira. Limitations to credit expansion of an individual bank. Number 1, deposit. The amount that an individual bank can lend is the function of the amount customers have deposited with it. Number 2, legal reserve requirement. This is inversely related to the amount of credit created. Number 3, the extent to which checks are used for transactions in the economy. Number 4, as a member of a banking system, a bank cannot expand credit more rapidly than other banks of the system. If it did, it would lose much of its reserve to other banks through the clearing out. The central bank. The central bank is the apex financial system in an economy. The central bank is the agent of monetary policy. This can be defined as the attempt to regulate the money supply, the terms and availability of credit. However, the instrument by which the central bank performs its roles vary from one country to the other. Functions of the central bank. Number 1, banker to the government. Banks, like other economic agents, need to hold their funds in an amount into which they can make deposits and against which they can draw checks. Such government deposits are usually held by the central bank. Number 2, manager of public debt. The central bank helps the government with its debt management. It helps the government in raising new funds and managing its debt instruments. For instance, the central bank usually purchases any part of new issues of public debt that is not taken up by other lenders on the day of issue at what seems like a reasonable interest rate. 3, banker to commercial banks. The central bank accepts deposits from commercial banks and will on order transfer these deposits among them. Central banks also lend money to commercial banks when they are short of cash or liquidity. Number 4, lender of last resort. Commercial banks often have sudden needs for cash, and one way of getting it is to borrow from the banks. Central bank is a lender of last resort because when other sources have failed, the central bank will lend money to commercial banks with good investment but in temporary need of cash. Those commercial banks may pay interest on the loan at a rate that used to be called the bank rate but is now called the minimum lending rate. Number 5, regulator of money supply. The central bank has great power to influence the money supply. By this power, the central bank tries to control inflation in the country. Instruments used by the central bank. The central bank uses the following instrument to control commercial banks. Number 1, currency control. In most countries, the central bank has the sole power to issue paper money. No attempt is made, however, to control the overall money supply by controlling the quantity of bank notes in circulation. Suppose that the public wishes to increase the fraction of total money supply it holds as notes and coins. Faced with a cash drain to the public, the commercial banks will withdraw deposit from central bank and the bank will print the necessary banknotes. The reserve base. Much more importantly than the currency control is the central bank's control over the reserve available to the banking system. The central bank requires commercial banks to hold reserves against their deposit liabilities. These reserves are called the reserve base of the monetary supply. Through the manipulation of this reserve base, the central bank can influence the money supply in an economy. Monetary policy. The central bank is responsible for the operation of monetary policy. One major objective of monetary policy is to influence the aggregate demand and through the national income, employment, and prices. Another objective is to provide a cushion for the country's financial system from the kinds of panics and crashes that have caused occasional financial havocs. The major tools of monetary policy have changed over the years. In the past, the central bank sought to influence the economy by influencing the time and availability of credit. It was believed that aggregate expenditure could be raised by making it easy to get credit on easy times and vice versa. More importantly, and more recently, central banks have shifted emphasis to controlling the supply of money directly and expecting these to have a definite effect on the interest rate and the amount of loan-financed expenditure. There are several ways by which the central bank tries to achieve this. These include open market operation, bank rate, reserve requirement, moral situation, and credit guidelines. Open market operation. These involve the sales or purchase of government securities in the open market. Through these, the central bank will be able to influence commercial banks' reserves and indirectly the money supply in an economy. An open market operation is very effective, particularly in countries with well-developed money markets. Bank rate. This is the price paid by the owners of security to the central bank for converting the security into cash. Bank rate. This is the price paid by the owner of security to central bank for converting the securities into cash. Interest rate charged by the banks follow the bank rate. Hence, by varying the bank rate, the central bank influences the availability and the cost of credit and hence money supply. Reserve requirement. This is the ratio of its deposit that a commercial bank must keep in the form of cash and common interest earning balances with the central bank. This requirement reserve ratio predetermines the maximum amount of credit that can be created by banking system. By the manipulation of the reserve requirement ratio, the central bank influences the money supply in the country. Moral suasion. It's a persuasive attempt by the central bank to the commercial banks to reduce the amount of their credit to the public. Credit guideline is also used to control the amount of credit given by commercial banks to which sectors of the economy is given. Money and capital markets. Where expenditure exceeds the receipt of firms or the government, the deficit have to be bridged by borrowing. The institution where funds are made available to firms and the government at a price, that is the rate of interest, are the financial markets. Because finance is required by different types of firms, by the government and by nationalized industries for different purposes and for different periods of time, there is a great variety in the type of loan available and in the institution providing or arranging such loans. Nevertheless, financial markets can be classified into two broad groups: the money market, dealing in short-term loans, and the capital market, where medium and long-term capital is raised. It must be stressed that neither the money market nor the capital market is a formal organization where buyers and sellers meet regularly in a particular building to transact business. Instead, they are merely a collection of institutions which are connected, in the case of money market, by dealing in bills of exchange and short-term loans. In the case of capital market, it is through channeling medium and long-term finance to those requiring it. Generally, money market comprises of the discount market, where in turn consists of institutions linked by dealings in bills, discount houses, merchant banks, commercial banks, and the central bank. Bills of exchange are an important source of short-term finance. The commercial bills are for firms and treasury bills are for the government. 2. Parallel money market, which has developed to meet specific requirements of particular borrowers and lenders to make for the restrictions placed on bank lending. The capital market consists of such institutions as the insurance companies, investment trusts, unit trusts, finance houses, building societies, etc. Summary. In this study session, we noted that money is any generally accepted medium of exchange. It has 4 functions: medium of exchange, means of payment, a store of value, a unit of value, and standard of deferred payment. Money is demanded for 3 main reasons: for transaction, precautionary, and lastly for speculative purposes. You learn that inflation is a period of general increase in price level. The control of inflation is also said to be a function of the causes of inflation. However, through a combination of monetary and fiscal policy, inflation can be reduced in the economy. Finally, you examine the main institutions in the banking system and the operation of the institution. This is the end of study session 7. Thanks for listening.